Hello learners, I hope you are able to follow the concepts which we have learnt so far. Today I am with one new topic, that is about Indian financial system comprising of different financial markets. Although financial markets are the integral part of Indian financial system or any financial system, because every country has got a financial system. So whatever financial system we have in India, that is called as Indian financial system. It has many components, but more importantly, we will be discussing about money market and capital market. So let us begin today's lesson. As you can see, we will be talking about introduction and role of financial markets, money market, a brief description, and capital market also. In brief, we will be discussing, because capital market and money market itself, they become the main course. So in this particular financial management course, we will be having an introduction of those two markets. So let us begin the things. Financial system. The financial system of an economy comprises of financial markets, financial institutions, financial instruments, and financial services. And it also includes apex bodies like RBI, SEBI, and other regulatory bodies. It means a financial system is such system which will regulate basically monetary aspects, flow of money in the economy. The basic aim of this particular financial system or basic function through financial system is achieved to regulate the flow of money in the economy, to regulate the capital formation in the economy, to regulate different entities which are involved in the capital market, money market, and other institutions. Like there are banking institutions, banks, other financial institutions are there, stock brokers are there. So who will regulate them? We have apex bodies like Reserve Bank of India, Securities and Exchange Board of India, and many more bodies are there. Similarly, we need some financial instruments also. So all those put together become the financial system. And always remember, there is a interlinkage between different markets. So that also we will be talking about. So in nutshell, financial system means a system which comprises of different financial institutions, financial intermediaries, financial instruments, financial services, and the regulatory bodies regulating all these institutions and instruments in the economy. That system is called as financial system. Now if you see Indian financial system, I have listed 4 prominent components. If we begin with the number 1, number 1 is mainly financial markets. As you can see, financial markets means such markets in which money and money related instruments, money related documents are bought and sold out. Like money related instrument may be equity shares, preference shares, debentures, bonds, and all that. That means such instruments through which flow of money gets done from one person to the another person. Or we can say financial system also helps in bridging the gap between those who are the funds providers and those who are the funds users. How this particular financial markets do it? For that purpose, we have 2 markets, money market and capital market. We will see in detail both of these markets. But primary objective, primary aim of financial system is to bridge the gap between fund providers as well as fund users. As you know, the individuals, companies, they save something for the future. Like if a person is earning 100 rupees or 1000 rupees or 1 lakh rupees or 2 lakh rupees or 50 crore rupees in a year, then definitely he will not spend all his earnings. He will save something for the future. Now, in the ancient time, what used to be there? People used to hold the cash like savings. How they used to manage? They used to keep it at their home, in the lockers, in the almirah, or in the cupboard. Or they used to dig a hole in the earth and keep it there, considering it is safe. Because their main concern was safety. They never thought of earning interest on that. In general, the households or anyone who might be there. But now look at the fact, those who need the funds, now who needs the funds? Industry, farmers, to finance their business activities, to finance their cultivation activities respectively. Similarly, people who want a loan for the housing purpose, buying the consumer goods, they need the money. So particularly, financial system will act as a bridge or linkage between movement of these funds which are already in surplus with someone. So now with the passage of time, people moved out, people evolved, system evolved, and then things like that, people were not interested to keep the cash at their home. Reason being, cash at home will be simply not generating any return on that. If you keep cash at your home for year, months and something like that, it will remain the same. And the moment we deposit the same money either in post office, bank, equity shares, bonds and something like that, we are likely to get the returns. And the moment this money is deposited in the bank, now what bank will do? Bank will use the same money to lend it to someone else who needs the money, like businessmen, business organizations, or an individual who wants a loan for the housing purpose, consumer vehicle or anything else. Consumer loans are there. Someone might need a loan for the buying the jewelry also, for household expenses also. Nowadays, banks are pretty good in giving the consumer loans. So in that way, financial system acts as a bridge or linkage between those who are the fund providers and those who are fund users. And both of these markets play an important role. So that one aspect is covered in the financial system. Then we have financial instruments. Particularly, financial institutions and financial instruments. So it is not instructions, it is financial institutions. So you can correct it, it is financial institutions. Financial institutions. Now look at the fact, when we say financial markets are there, the markets in which money and money related claims are bought and sold or dealt with, then definitely there has to be some institutions in that market. So we have regulatory institutions like Reserve Bank of India, responsible or authorized or having the powers to regulate banks and the financial institutions. Then Securities and Exchange Board of India at present has the power to regulate all the entities in the capital market. Then banking institutions. This will comprise of banks mainly. It may be regional rural banks, commercial banks or cooperative banks. Then we have non-banking finance companies. Such finance companies which accept the deposit from the general public and use the same deposit for lending purpose, but they don't act like a bank. See, in those institutions, in those non-banking finance companies, you cannot open a savings bank account or current bank account. Simply, they will accept the deposit under certain scheme, they are allowed by RBI, and then the same money will be lent. Like we have gold finance companies. If you need loan against your gold, because gold lying in your locker will not generate anything. So sometimes people, what they do, whatever gold jewelry or hard gold they have, pure gold, they can give to the gold loan companies. These gold loan companies will give a loan to the person who has pledged his gold, who has hypothecated his gold, जिसको हम हिंदी में बोलते हैं गिरवी रखना. So those who have pledged the gold, they might get the loan against that gold. They will keep on paying the interest, and then ultimately, the moment they repay the loan, they can get back their gold or jewelry, whatever they have deposited. Similarly, non-banking finance companies are the one, they are not the bank, but they are giving support in the form of giving consumer loan, vehicle loan, housing loan, or it may be lease financing or hire purchase. So those are the non-banking finance companies regulated by Reserve Bank of India. Development financial institutions. So development financial institutions are the one which are not the banks, but their basic task is to provide lending support for the developmental work in the economy, like IFCI, ICICI, IDBI, all those are the developmental financial institutions. Then we have the mutual funds. So mutual funds is simply like a trust which is accepting investors' savings, and purpose of accepting that investor's saving by issuing the units to the investors or contributors or subscribers is that whatever money is collected from small investors or retail investors, that money will be invested in either money market, capital market or commodity market depending upon the objective of the scheme. And in India, Unit Trust of India was the first mutual fund to launch such kind of schemes. So mutual fund we will discuss in detail, and that will be the last lesson of this particular course. We have some kept one scope for the mutual funds also. So mutual fund in this particular class I will not be discussing in detail, but yes, there will be one devoted class to mutual fund. Then we have, like when we say financial markets are there, financial institutions are there have to be some financial instruments through which exchange of money, flow of money can be executed. So financial instruments may be long-term instruments like equity shares, long-term bonds and something like that. Or these may be short-term instruments, the instruments which help in borrowing and lending the money for the short-term period. Medium-term period also is there. So generally, period more than 5 years is considered long term in the money market and capital market. Period up till 1 year is short term, and period between 1 and 5 is considered medium term. So up till 1 year short term, 1 to 5 years medium term, and beyond 5 years is long term period. So there are certain instruments like equity shares, preference shares, bonds and something like that, fixed deposit receipt and all that. Then we have financial services, lease financing, and a company which is giving its own assets to someone else for use. Like a company might be there which buys the cranes or earth movers from the market and gives it on a rent basis to some contractor to build the road or dam or something like that. So what that particular person who is buying the crane or earth mover, he is giving on a lease. So to give on lease means you are giving your asset to someone else and that other person will use it. And against the use, he will pay the rent to the owner of the asset who has given him the asset. So lessor and lessee concept is there. So such kind of companies are also there. Then we have hire purchase companies. There are the companies which facilitate the buyers not to pay all the amount of the product in one go. Rather, they will say you make the down payment today and rest of the money you can pay in installments. So generally people consider that as an installment payment system, but system is hire purchase system. So you are buying the product, making a small payment as token amount or called as down payment, and rest of the payment is made in the installments. Definitely the person who is giving you things on hire purchase or the company which is giving you things on the hire purchase will charge interest on the future payments which you will make. Then installment payment is also similar, but technically there is a difference between lease financing, hire purchase and installment payment. But in this course these are not covered in detail. I have given a glimpse of that. Then merchant banking institutions. A merchant banker is the one who is an intermediary who facilitates the activities in the capital market and money market. Take a simple example. You might have heard about IPO. Companies come out with the IPO. Now, when you come out with the initial public offering, all activities has to be performed by the company itself, issuing company. So they have to plan for the issue, they have to seek the regulatory permission, they have to execute the things like they have to appoint the banker to the issue, they have to appoint agents, brokers, underwriters, advertise for the same, collect the money from the subscribers and then come out with the allotment and dispatch of the shares dispatch of the allotment intimation, all those activities are practically to be done by the company. Now, what this merchant banker does, he offers the services to the companies which are coming for the IPO, rights issue, or FPO, and he will provide all the services to the company by charging a fee. So, that is the one kind of service provided by the merchant banker. Similarly, a company might be interested to take a loan. Now, when you go and to a bank or financial institution to take a loan, definitely certain formalities have to be completed. Legal formalities, contractual formalities and all that. So, either you do on your own or you can take the help of a merchant banker. So, merchant banker will also do like that also. There is something like as loan syndication. In a loan syndication, more than one lender is giving you the loan. Now, either you yourself go to n number of lenders, negotiate with them that against one single property or for one single project, you need a loan and there are 3 lenders. So, talking to 3 lenders, negotiating with 3 lenders might be time consuming, difficult for you. It might involve certain regulatory aspects, legal aspects. So, instead, a businessman what he does or company what it does, it can hire the services of merchant banker. Merchant banker will perform all the activities on the behalf of borrower, complete the regulatory aspects, negotiate with all the lenders, cartel of the lenders, and then finally provide the funds to borrowing company. So, this is the way merchant banking services are there. Then we have factoring and forfeiting services. Factoring and forfeiting services are with respect to the financing of receivables. So, again, these are not dealt in detail in this particular class. Yes, when I teach you about working capital, I will be talking in detail about factoring services and forfeiting services. So, all these things are the components of financial system, and almost that kind of components are there in every country. Certainly, institutions might be insurance companies. They are also the part of financial institution. Insurance Regulatory Development Authority, regulatory body. So, all those institutions are also covered, all those instruments are also covered in this particular financial system. So, that is the way we say financial system is the one which acts as a bridge between providers of the funds and the user of the funds. It helps in flow of the money in the economy, and definitely then there has to be an aim of that financial system. So, let us see what is the aim or objective of this financial system. We have financial markets. So, aim will get covered when I discuss about financial markets in detail, because our main focus is on money market and capital market. So, quickly we will do that because these are covered only for an introductory purpose. Now, what is money market? Financial market is the market for money and monetary claims. Money market and capital market are 2 prominent financial institutions. Now, look at the fact. There is a one broad term, financial markets. Financial markets are the markets in which either money or money related claims are bought and sold, are exchanged between different parties. And this market, that is financial market, has 2 components, money market and capital market. One small definition or one small differentiation can help you in identifying difference between money market and capital market. Money market is basically meant for short-term claims, short-term instruments, whereas capital market is for long-term instruments. So, now what money market is? It is the market in which liquid funds, that is cash, as well as highly liquid securities are traded in for a very shorter duration. So, generally duration of the transaction is also very short, and instruments also are of short term duration. Like if I give you an example, in the money market one prominent instrument is treasury bills. So, maturity period of the treasury bill cannot exceed 365 days, does not exceed 365 days. So, that kind of instruments are there. Similarly, buying and selling of cash, that means those who are having surplus cash, they give it to the person who needs the funds for a period of 1 day, 2 days, 7 days, 1 fortnight. So cash is bought and sold. In that market is called as money market. And the central bank of the country, like in India, we have RBI, Reserve Bank of India, which controls this particular market. And purpose of RBI is to regulate the flow of money in the economy. So with the help of money market instruments, RBI will be regulating flow of money. RBI will be regulating flow of money. So let us quickly see what are the main instruments in money market or main components of money market. We have call money market, government securities market, commercial papers and market for bills of exchange. Call money market is the market in which surplus cash of different entities is bought and sold. That means suppose SBI, State Bank of India, has a surplus cash of 100 crore rupees today, and ICICI Bank needs that fund only for 1 day or 2 days or 7 days. So simply ICICI Bank will buy from SBI 100 crore for 1 day, and for that 1 day ICICI Bank will pay the interest to SBI. All the transactions are done over the phone, and in that way ICICI Bank, which is running short of funds today, it is an example. It is an example like this, banks do it. So call money market transactions are done. So the market in which surplus cash of one party and other party is bought and sold. So person who is buying the surplus cash is the borrower, and person who is selling the surplus cash is the seller. So seller must get some benefit, so he earns the interest on his surplus cash. Government securities or gilt-edged securities. These are the securities which are issued by either central government, state government or any agency of the government for which government is taking the guarantee. So they are highly safe, and their safety is as good as gold. Their liquidity is as good as gold. That is why we call them as gilt-edged securities. It means to say, if you have purchased government securities or invested money in the government securities, you can easily sell them. Reason is that if suppose there is no buyer in the market, because majority of the government securities are issued by RBI, Reserve Bank of India in India. So RBI is ready to buy and sell those particular securities. So RBI is the market maker in those securities. A market maker is the one who provides both buying and selling quotation round the year, round the clock. So government securities are highly safe and their liquidity is at par with the gold. Then commercial papers. Commercial papers are issued by the companies to borrow the money from the market. So these are short to medium term instruments to borrow the money. So companies with good net worth, having good credit rating, can issue the commercial paper subject to the RBI guidelines. So that money is used by the company. On those commercial papers, companies will pay the interest. Then market for bills of exchange. You might have heard about bills receivables and bills payables. So a company which has sold goods on credit to its customer, he has written a bill on the customer, customer has accepted the bill. Now, customer will pay after 90 days. Now, instead of waiting for the 90 days period, company can right now go to a bank and get the bill discounted. Let us say bill is of 1 lakh, bank after deducting a discount charge of 1,500 pays to the company 98,500. Now, system will be like this. On the maturity date of the bill, bank will approach to the person who has accepted the bill. He will pay 1 lakh to the bank, so bank has earned 1,500. Because right now bank is giving 98,500, against that bank gets after 90 days, that is duration of the bill, 1 lakh rupees. Now your question might be there, if suppose the person on whom bill was written, the person who has accepted the bill denies to make the payment, then need not to worry. Bank will come back to the original person who had taken the money against the bill, who had got the bill discounted. And in that way, bank will get back his 1 lakh rupees. So that system is called as market for bills of exchange. So the call money market, gilt-edged securities market, and in the money market, we have prominent instrument, treasury bills. So treasury bills and dated securities, two things are there in the money market. So treasury bills, you can see, as I said, they don't have the maturity period beyond 365 days. So Typically 364 is the maximum maturity period. So these are issued at par, and these are issued at a discount to par value and redeemed at par. So there is no provision for interest payment time to time. Whereas gilt as securities issued by either government or guaranteed by the government, in which there is a provision for interest payment. Commercial paper we have discussed. Now we come down to the other part. So far what we have discussed? We have discussed about money market, and basic purpose or function of the money market is to facilitate Reserve Bank of India to control or regulate the flow of money in the economy so that inflation is under control. So RBI uses money market instruments to have a check and balance of the flow of money in the economy so as to have inflation under control. So that is basic motive or purpose served with the help of money market. Then comes what is capital market. Capital market is the market in which companies find an opportunity to raise the capital directly from the one who are the providers of the money, providers of the capital, by issuing securities like equity shares, preference shares and debentures. And these three things we have already seen: what are equity shares, what are debentures and what are preference shares. Capital market is for the long-term instruments, long-term securities. It has got two segments: primary market and secondary market. Primary market is the market in which different companies can issue the securities by following the mechanism of fundraising. Securities which are issued in the primary market we have already dealt with in the previous sessions. Now, how these securities are issued by the companies in the primary market? So there can be a public issue, rights issue, private placement, public issue through book building and buyout deals. So these are the fundraising mechanism adopted by the companies. Then capital market has got one more segment, secondary market, also known as stock market. Secondary market is the market in which already issued securities are bought and sold through the intervention of the broker. It means stock exchange is such place where you can contact the broker of the stock exchange, place an order to buy the shares or sell the shares if you have. It means in this market outstanding securities are bought and sold through the intervention of stock brokers. Stock brokers are the members of the exchange. So in any country, whether it is India, USA or UK or Germany or Japan, all the stock exchanges are regulated by the regulatory bodies. It means the stock exchange which is functioning in the country should be recognized stock exchange. So stock exchange is a regulated marketplace in which both buyer and seller give their quotation for the buying and selling of the securities. It is open quotation system. Open quotation system means if I want to buy some shares, I'll simply display my open quotation. Okay, I want to buy shares of X company at 200 rupees per share. Anyone who is interested to sell at this price, he can come and contact me. So that address of my quotation is not for any particular individual seller. I am inviting any seller can come and sell me. So it may be a situation, if I say I want to buy at 200, someone might come and say he is ready to sell at 200 or he is ready to sell at 205, or he might say, okay, I am in need of money, urgently I can sell at 199 also. It happens sometimes. So in that market, it is an open system of quotation. But yes, it is regulated as of today by Securities and Exchange Board of India. Earlier, it used to be regulated by CCI, Controller of Capital Issues, till the year 1992. From 8th May 1992, we have Securities and Exchange Board of India regulating this market. So that is all, dear learners. In this particular, we have given a brief description of money market and capital market and understood what is the role of financial system and what is the role of financial markets. Keep on learning. Thank you for giving me your time.